In this video, I'm going to be explaining what the VIX is, what it's telling you in the markets, and how to trade it. Now, some of you might have heard the word being thrown around, VIX, volatility. Now, what it actually stands for is the CBOE Volatility Index. Okay, it's actually what is used to measure the fear in the markets over the next 30 days based on the pricing of optional contracts on the index. Now, it's not really a price. Most people confuse it with a price. Rather, it's a percentage that represents the expected annualized move in the S&P 500, usually in the next 30 days or so. Now, this is actually a very useful tool if you're an options trader and even a futures trader, because it indirectly translates what the market is going to do. Okay, basically measures the fear of people trading in the markets, usually being tracked by the S&P, and the VIX has also helped me personally, especially trading options. So the VIX is derived from implied volatility of a wide range of S&P 500 options contracts across multiple strike prices, expiration dates. So when traders are nervous and buying puts options heavily for downside protection, the cost of those options usually rises. And because implied volatility is what drives options, the VIX also rises with it. So what you're seeing here is the VIX. Okay, now this is actually the levels that I've marked here. These are different levels. Now, what is considered a normal VIX reading is anything between 15, as you can see I've marked here, 15 and 20. So anything that falls between this level here is actually a normal VIX. Okay, nothing much is really happening. There's no panic. There's nothing much that's happening here. It's very, very normal. So this is where most people prefer to trade. Options traders prefer to trade VIX when the markets are usually in this range, because contracts tend to be cheaper when they are at this range. Now, when the VIX is above 20 to 30, this usually signifies uncertainty. Okay, options tend to be more expensive around this area. Moves happen a lot. It's actually considered a dangerous levels to trading, because as you can see what happened over here, March, the moves were very, very unpredictable here. Okay, there's a lot of volatility over here. There are lots of chops over here, market chops over here. So this is an area most options traders tend to stay away from, because there's a lot of uncertainty here, and also contracts tend to be much more expensive. So usually when the market's over here, I don't trade. Also, I try to avoid this level here, because you can easily lose a lot of money or even just blow your account, because anything can happen over here. Now, when the market is above 30, between 30 to 40, this is now genuine fear. Okay, people tend to stay away from this level. As you can see, there's nothing much that happens in these levels. This happened during this was last year, April 2025, when Trump announced the tariffs. Most traders know what happened here. So there was lots of panic over here, and this is where you actually want to stay away from the markets completely. Now, it's beneficial for sellers because most people are selling out. This is good for sellers and bad for buyers. Options, of course, are expensive. They're much more expensive than when they are below 30. So just avoid it once the market gets over here. Okay, unless you tend to sell, and if you are good actually trading, this is something that you can actually trade, but not buy. Okay, now when the market is above 40, this is usually a crisis. Okay, this is actually considered a market crisis. This was also affected by last year's Trump tariffs, but it's usually less likely when the market is above over here. Okay, people try to avoid these areas. Buyers actually avoid these areas. Sellers still thrive over here, but it's still a risky place to be. Okay, contracts, of course, are very, very expensive. So if you can go back, let's see, COVID also must have spiked this. This was 2024 August. Can't remember what really happened here. This must have been the Ukraine war. Okay, this is when the Ukraine war was started. If we go back further, let me go to weeks. Okay, now as you can see, this was in 2019, 2020. This was during COVID. As you can see, it went way above 40. All right, look at where it reached. This was really, really high. This actually reached 85. Wow, this was really, really high. Now, if you are here and you are pretty much selling, you'd have been a millionaire. The guys who sold during this crisis made so much money, so much money. All right, so the VIX movement is good and bad. Okay, it's actually very important to have the VIX if you're an options trader, to actually gauge, the fear of the market, what people are actually thinking, or basically what the market is thinking, or how people are trading in general, because it tells you actually how people are trading. This is actually pretty much the fear of the markets. And the S&P 500 and the VIX, they tend to move in opposite directions. Okay, most of the time you will see, like for example over here, the VIX spiked at 35, and during this period, if you go to S&P 500, you will see an inverse chart. Okay, almost an inverse chart. What you would have seen in S&P 500 is that the market dropping down to an equally opposite direction. Okay, so it tends to be kind of reverse of the S&P 500. So because, like I said, this is pretty much the fear. It's actually measured by the S&P 500, or rather the expectation of the volatility of the S&P 500 in the next 30 days. So if you're especially trading the S&P 500, you'll really need to use the VIX a lot, especially with this administration of Trump. Okay, Trump is very unpredictable, and you need to be utilizing the VIX chart. And also when the VIX is high, the implied volatility is high across the board, which means options premium are expensive. So buying options when the VIX is elevated means you are pretty much paying a premium price for contracts that will lose value quickly if the volatility subsides, even if the market moves in your direction. So this is actually called the IV crash, and it is one of the most common ways option buyers tend to lose money during and after news events. So when the VIX is low, the options premium are cheap, which makes options contracts attractive for most buyers, but it also means the expected moves are smaller. That is the only problem when it comes to these cheaper contracts, or when the VIX is actually on a steady condition. So what you should do as a trader, if you are trading options specifically, you should always try to check the VIX just before the market open. Even for futures traders, okay, this is also important, just as it is for options traders. So a VIX spike overnight tells you to expect volatility, and also fast moving price action during the session. So always be careful with that. But again, a lower stable VIX basically tells you to expect a lower movement. Okay. Now for futures trading, especially ES and NQ, when the VIX is elevated, they both experience larger point swings per session, which usually affects where you place your stops. So a stop that's appropriate on a 15-day VIX may be too tight on a 30-day VIX and get taken out by normal noise before the trade even has a chance to develop. So you have to have a bigger stop loss when you're considering trading these levels on the VIX. Now, if you're a more risky trader, which is something I don't recommend, you can just trade without a stop loss. But that is something that you shouldn't do. I personally always trade with a stop loss, and you should always have a stop when you're trading these markets. So now I'm going to show you how you can adjust your stop loss for VIX. So it's pretty much just like any other trading. Okay, you just want to add a larger stop loss. So just in case you've never used a stop loss here on IBKR, what you can do, for example, you're trading MNQ over here, and I'm going to go to the options menu and say I want to get into one at the market, or just at the market. I'll select that, and on my right hand side, I'll just have one quantity or one contract, and I'll always place my market because I want to get into the market immediately. And then here is where you add. Okay, you can attach your orders over here. All right, so this is for your profit taking. You can adjust your profit taking over here, and you can adjust your stop loss. Now usually I don't adjust my profit taking, I just get into the market with a stop loss, okay, without a profit take. So currently it's at 145. Okay, it keeps moving because the price is constantly moving. Currently it's at 145, now it's 150. Now for me, I normally place my stop loss like $30, a space of $30. Now when the VIX is above 30, we saw that it can be on dangerous levels, or there is fear in the market, so there can be high volatility there. So I would typically add just something between $50 and above. So for example, if it's 149 here, I would place my stop at 100. Okay, around 100 there, because remember, between $30 to $50 is a good enough space for a stop loss. So let me say I'm going to place it at 110. Okay, like $110 stop loss. Okay, so something like that. So this will give you enough room, or this will give the market enough room for that volatility to happen, which will not easily take you out of the market, okay, in case the market reverses against you. So you can easily just click on submit order from here, and then you hit transmit. Okay, so volatility is something to actually pay attention to if you're a futures or a stock options trader. Okay, personally I have used it and it really helps, especially with this Trump administration where the markets can be unpredictable. Now if you want to learn how to set up futures or how to trade futures, be sure to check out this video over here. And if you like this video, please leave a like, subscribe to the channel if you haven't, and I will see you on the next one.